investment. Hey, welcome back to the channel. If you're new here, I'm glad you're tuning in because today we're diving into something that affects every single American. A good investment, whether you realize it or not. The real tipping point when US debt turns from manageable to dangerous. We're going to break it down in a way that's simple, practical, and something you can actually understand. So by the end of this video, you'll know exactly what to watch for and how it could impact your wallet, your investments, and the economy as a whole. So grab a notebook, pay attention, and let's get into it. When people talk about the United States national debt investment, numbers like 35 trillion or 45 trillion get thrown around and it can feel abstract, huge, scary, but abstract. The reality is that debt by itself isn't always the problem. What really matters is the point at which that debt starts to affect the government's ability to operate efficiently, to fund essential programs, and to respond to crises without jeopardizing the economy. That point is not a fixed number. It's about the balance between what the government owes and what it earns, specifically when interest payments start to dominate the budget. Right now, interest rates have been historically low for years, investment, which has allowed the government to borrow enormous amounts without immediate consequences. But even small increases in interest rates can quickly change the picture. Imagine the government has to pay hundreds of billions more every year just in interest. That money has to come from somewhere, which usually means either cutting spending in critical areas like education, healthcare, or infrastructure, or increasing taxes, or borrowing even more. None of these options are painless. Every dollar spent servicing debt is a dollar that's not going into programs that directly impact people's lives or into investments that could grow the economy. Investment. It's also about timing and compounding. When debt grows faster than the economy, it becomes a larger and larger share of government revenue. That's when the tipping point starts creeping closer. Right now, the US government collects roughly $4 trillion a year in revenue, while interest payments on the debt are over $600 billion. That's manageable. But if rates rise or the debt continues to grow, investment, that interest portion could double or triple over the next decade. Suddenly, the government could be spending a quarter or more of its revenue just on interest. At that stage, borrowing to fund new programs becomes riskier. Markets may start demanding higher interest rates for US debt, and the government loses flexibility. Flexibility is key because economic crises, natural disasters, and national emergencies require the government to act quickly. If most of the money is tied up paying interest, that agility disappears. Another angle to consider is how this affects ordinary Americans. When debt payments dominate the budget, governments have fewer resources for things like social security, healthcare programs, and education. Taxes may rise, public services may shrink, and borrowing costs for everyone. Mortgages, car loans, student loans could increase because the government is competing for money in the credit markets. Even if the economy is growing, rising debt burdens create a kind of pressure cooker effect. Small shocks, a recession, a sudden spike in energy prices, or an unexpected financial crisis can have an outsized impact when debt levels are high and interest payments are consuming a growing share of revenue. So the real point when US debt turns bad is not simply crossing a dollar figure. It's when the cost of servicing that debt starts to crowd out everything else the government needs to do and threatens economic stability. That's the line policymakers watch for, even if it isn't obvious to the average American. And this is why investors, analysts, and economists pay so much attention to the ratio of debt to GDP, interest rates, and government revenue. Because when that tipping point is reached, investment, the consequences ripple through the entire economy, from Wall Street to Main Street, and they do so quickly, often faster than most people anticipate. Understanding this helps put headlines about the national debt into perspective. It's not the number itself, it's what that number does to the government's flexibility, spending priorities, and the overall health of the economy that really matters. High debt alone isn't automatically a disaster. Countries can carry massive amounts of debt and still function without crisis if investors trust their ability to repay and interest rates remain low. The real danger appears when the cost of borrowing starts to spike and markets begin doubting the safety of government debt. That's when things move from manageable to risky very quickly. Investors, both domestic and foreign, play a critical role in this. When they feel confident, they're willing to buy government bonds at low interest rates. That confidence keeps borrowing costs low and allows the government to finance programs and services without extreme measures. But if doubts emerge, say, about the country's fiscal policies, economic growth, or political stability, investors may demand higher interest rates to compensate for perceived risk. Suddenly, the cost of servicing debt rises, and the government is caught in a tightening spiral. This is why debt sustainability isn't just a number, it's about market perception and trust. If investors start thinking US Treasuries aren't as safe as they once believed, Even a slight increase in yields could translate into tens or hundreds of billions of extra dollars the government has to pay annually in interest. That shift can happen fast. It doesn't take a catastrophic event. Sometimes a warning from credit rating agencies or a shift in global economic sentiment can trigger it, because the US dollar and Treasury securities are central to the global financial system. Any sudden loss of confidence doesn't just affect the government. It ripples through global markets. Asset prices, mortgage rates, and investment capital all feel the impact. Another factor is the compounding effect of rising borrowing costs. Even if the government continues to issue debt to cover shortfalls, the increasing cost of that debt accelerates the overall burden. Interest on interest begins to eat into the budget in a way that's hard to reverse. Policymakers then face difficult choices: raise taxes, cut essential programs, or continue borrowing at higher rates, each with serious consequences. Rising borrowing costs make fiscal planning unpredictable and can create cycles of instability where markets demand higher returns because the government looks riskier, which in turn makes the government riskier. This loop can be subtle at first, but becomes much more pronounced over time if unchecked. It's also crucial to understand that these dynamics aren't isolated to government finances. They directly impact the broader economy. Higher interest rates on government debt often push up rates for businesses and consumers as well, making loans more expensive and slowing economic growth. Investments that would otherwise drive productivity and innovation may be delayed or abandoned. For the average American, this can mean higher mortgage payments, increased borrowing costs, and slower wage growth. Even a seemingly distant shift in government borrowing conditions can trickle down and affect everyday financial decisions and long-term planning. The warning signs are often subtle too. Inflation, changes in bond yields, or adjustments by international investors may initially seem minor, but they indicate shifts in confidence and risk assessment. Economists and analysts watch these signals closely because when markets begin to question the safety of debt investment, the consequences can snowball rapidly. Governments have historically avoided the worst-case scenarios by maintaining credibility, managing debt growth relative to the economy, and keeping borrowing costs predictable. But the moment confidence erodes, the system can respond abruptly, leaving limited room for maneuver. So, while massive debt isn't automatically catastrophic, the real problem arises when borrowing costs spike and confidence falters. That's the scenario that turns manageable debt into a potential crisis. It's not just numbers on a balance sheet. It's a chain reaction affecting interest rates, government spending, markets, and ultimately the financial stability of everyday people across the country. Investment. Understanding this distinction is critical because it shifts the focus from mere debt accumulation to the real risk factors that determine whether debt becomes a real problem or remains under control. Debt doesn't exist in a vacuum. It's deeply connected to economic growth, inflation, and the overall confidence in the financial system. Even if the US owes trillions of dollars, the situation remains manageable as long as the economy grows faster than the interest burden. Investment. When growth is strong, the government can collect more revenue without raising tax rates, pay interest comfortably, and continue funding essential programs. But if growth slows or the economy slips into recession, the dynamic changes dramatically. Investment. The same debt that seemed harmless during periods of expansion can quickly become a major problem. This is why monitoring economic indicators alongside debt levels is crucial. Slow growth limits the government's ability to generate revenue. Investment, combined with rising debt payments, it creates a pressure point that can push the financial system toward instability. Inflation plays a dual role in this equation. Moderate inflation can help governments manage debt because it effectively reduces the real value of outstanding obligations over time, making repayments easier. But high inflation, or worse, runaway inflation, erodes confidence in the currency and in government bonds. Investors may start demanding higher interest rates to compensate for the risk of losing purchasing power, which in turn drives borrowing costs up. This is the exact situation policymakers fear when debt servicing costs rise, not because of reckless spending alone, but because inflation and market expectations shift in ways that increase financial pressure. And even a small misalignment between inflation and interest rates can snowball into significant challenges, affecting the ability to fund programs, manage social commitments, and maintain market stability. Global confidence is equally important. The US dollar and Treasury securities are pillars of the international financial system. Foreign governments, institutions, and investors hold large amounts of US debt because they trust it as a safe asset. But confidence can be fragile. Geopolitical tensions, policy uncertainty, or fiscal mismanagement can make foreign investors hesitant to continue financing government debt at low rates. When that happens, borrowing costs rise, the government's flexibility decreases, and the risk of economic shock grows. Maintaining global trust is therefore not just a political goal, it's an economic necessity. The moment investors start questioning the reliability of US debt, the ripple effects are immediate. currency fluctuations, higher interest rates, and potential disruptions in credit markets worldwide. Another key factor is the relationship between debt and the private sector. When the government borrows heavily, it competes with businesses and individuals for capital. If interest rates rise to attract investors, it can crowd out private investment, slowing growth and innovation. Entrepreneurs may delay projects, companies may reduce hiring, and households may face higher loan costs. The debt burden thus indirectly affects economic vitality beyond government spending. A delicate balance exists where debt, growth, inflation, and investor confidence intersect. Mismanagement or unexpected shocks in any one of these areas can tip the balance, turning a manageable situation into a precarious one. It's also important to recognize timing. Debt can remain sustainable for years if growth and confidence remain strong, but vulnerabilities accumulate silently. Small changes in interest rates, inflation trends, or growth projections can suddenly expose weaknesses that were previously hidden. This is why economists often emphasize ratios rather than absolute numbers. Debt as a percentage of GDP, debt to revenue ratios, and interest to revenue ratios provide a clearer picture of sustainability than just the total dollar amount. These ratios help predict when debt could become a real problem rather than simply assuming that a high nominal value is automatically dangerous. Ultimately, the key takeaway is that even massive debt can be managed if growth outpaces the burden and markets maintain confidence. Problems arise when growth stalls, inflation misaligns with expectations, or confidence falters. That's when debt becomes more than a statistic. It becomes a tangible threat to economic stability, government flexibility, and financial security for the average person. By understanding these relationships, it's possible to anticipate when debt could turn bad and why it matters far beyond the numbers on a spreadsheet. When debt reaches the point where it begins to turn bad, the consequences extend far beyond government balance sheets. They touch the lives of everyday Americans in very tangible ways. Investment. The first and most obvious effect is on taxes. As interest payments consume a larger portion of government revenue, policymakers face tough choices. One of the quickest ways to generate more funds is through increased taxation. This can come in the form of higher income taxes, increased payroll taxes, or elevated corporate taxes. For working Americans, that often means less take-home pay and smaller disposable income. For businesses, higher taxes can translate into slower hiring, reduced expansion, and a tightening of wages. The economy as a whole may slow, and individual households feel the pinch directly in their monthly budgets. The impact is subtle at first, but over time, higher taxes to service debt can change consumption patterns, reduce investments, and even limit opportunities for wealth building. At the same time, government services are often the first casualty when debt becomes unsustainable. Programs that people rely on, healthcare, education, infrastructure maintenance, social security, may face cutbacks or slower growth. Roads, bridges, and public transportation may fall behind on maintenance. Educational programs may struggle to expand or retain quality. Healthcare access and funding can be constrained, affecting millions of families who depend on public assistance or federally supported programs. These effects are not theoretical. They have real consequences for daily life. Families may have to spend more out of pocket for services that were previously subsidized, and communities may face longer-term declines in quality of life. When debt becomes unmanageable, the government's ability to serve its citizens effectively diminishes, creating a ripple effect that touches every sector of society. Financial markets are also highly sensitive to rising debt burdens. Investors track debt levels, interest rates, and fiscal policies closely. When debt is perceived as risky, market volatility increases. Stock markets may experience sharp swings, mortgage rates can rise, and lending costs for businesses and consumers can climb. Investment debt. These changes affect everything from retirement savings to home purchases. For the average American, even small shifts in interest rates can have a big impact on monthly payments and long-term financial planning. A household with a mortgage, student loans, or credit card debt suddenly faces higher costs, reducing their ability to save, invest, or spend freely. The economy becomes less predictable, and financial stability for millions of people is challenged. As another critical consequence is the potential for a loss of confidence. Both domestic and international confidence in the U.S. economy and currency can waver when debt spirals. A loss of trust can weaken the dollar, increase inflation, and make borrowing more expensive, not just for the government, but for every American. Imports may become more costly, and everyday goods can rise in price. Savings may lose value, and long-term financial goals, like buying a home or planning for retirement, become harder to achieve. The effects compound, showing that debt is not just a government problem. It's a personal financial concern for anyone participating in the economy. Ultimately, when debt crosses the threshold from manageable to risky, the consequences touch every corner of life. Taxes rise, public services suffer, financial markets become more volatile, and individual financial stability is threatened. These changes highlight why managing debt is about more than just numbers. It's about protecting the economy, safeguarding public services, and ensuring that ordinary Americans can maintain financial security. Recognizing this connection makes it clear that the moment debt starts turning bad, it is not only a government issue, but a societal one, affecting real people, real households, and the broader economy in ways that are impossible to ignore.